If you're an ambitious business owner, you've probably hit this wall. You have this amazing vision for growth, right? But that vision, well, it needs fuel. So today, we're going to build the playbook for how to fund that growth the smart way, using debt as a powerful tool, not a dangerous trap. Let's dive in.
This is really the question at the heart of it all, isn't it? That drive to expand, to get to that next level. That's probably why you got into business in the first place. You can see the potential, and you're chomping at the bit to make the moves.
But, and this is the big but, there's a fundamental tension here. See, growth costs money. It just does. Whether you need new equipment, a bigger warehouse, or more people on your team, scaling up requires capital. And a lot of the time, that means borrowing. And borrowing, well, it always brings some risk.
So, that brings us to our first really crucial idea, this concept of walking the over-leveraging tightrope. Look, using other people's money can be an incredibly powerful strategy, but you've got to be careful. One little misstep and things can get disastrous, fast.
Okay, so what exactly are we talking about here? What is this danger? Well, over-leveraging is basically when your debt load becomes a heavy anchor instead of a powerful propeller. It means that when you hit a slow month, and you will, or the market takes an unexpected turn, those loan payments could literally sink the entire ship.
This is why knowing the warning signs is so crucial. You have to ask yourself, are my debt ratios starting to creep up? Are those interest payments squeezing my profit margins? And maybe most importantly, is my cash flow, the lifeblood of the business, feeling tight? These are not just numbers on a spreadsheet, folks. They're alarm bells telling you it's time to stop and reevaluate.
All right, so enough with the doom and gloom, right? Let's talk about the solutions. Because smart borrowing isn't about avoiding debt altogether. Nope, it's about using the right kind of debt for the right job. The best way to think about it is like having a toolkit.
You wouldn't use a hammer to turn a screw, would you? Of course not. It's the same with your finances. You need the right tool for the job. A business line of credit? That's your flexible wrench, perfect for managing those short-term cash flow gaps. A term loan? That's more like your power drill for a big one-time investment like an expansion. And equipment financing? Well, that's a super specialized tool for buying the specific machinery you need to get things done. Matching the tool to the task, that is step number one in strategic borrowing.
Okay, now for a really crucial perspective shift. This is a big one. If you want to get the best deal possible, you have to understand the person sitting on the other side of the table. You need to start thinking like a lender. And look, this isn't just about filling out an application and hoping for the best. It's about presenting your business in a way that speaks their language. And what's their primary concern? It's one word: risk.
So how do they actually figure that out? How do they assess you? Well, lenders don't just look at one single thing. They create what's called a blended credit risk score. And what they're doing is pulling together data from three key areas: your personal credit history, your business's own credit file, and other characteristics, like your industry and how long you've been in business. It's this whole 360-degree view of your financial identity.
And after all that complex data crunching, what do they get? It's actually pretty simple: a 3-digit number. You can think of it just like a FICO score, but for your business loan. And the rule is simple. A higher score means less risk in their eyes. And less risk for them translates directly into better terms and a much better chance of approval for you.
And believe me, this is not guesswork. Lenders use these super complex data models, kind of like what you're seeing here, and they're constantly tweaking them, constantly getting better at predicting who's going to pay back a loan. The big takeaway for you here is that their decisions are incredibly data-driven. So your job is to make sure your financial story paints a picture of a future that they absolutely want to bet on.
All right, now let's zoom out for a second. Because, your business doesn't exist in a bubble. There are these huge economic forces out there, and one of the biggest is interest rates. They create these waves that you absolutely have to learn how to navigate. So let's talk about what that actually means for your loan.
When you hear on the news that interest rates are up, that's not just some abstract economic thing. It has a real, direct impact on your business. It means higher monthly payments, for one. It also means lenders are going to be looking at your cash flow with an even stronger magnifying glass. On the flip side, when rates are low, borrowing gets cheaper, and refinancing to lock in a better deal becomes a really attractive option.
So the big question is, how do you protect your deal no matter what the rates are doing out there? Well, you focus on the things you can actually control. Keep your financial records absolutely spotless. Use a down payment strategically to improve your pricing. And this is a big one: pick equipment that holds its value well. All of these things make you a much less risky bet, whatever the economic climate looks like. Okay, so we've covered a lot of ground. We've talked about the risks, the different tools in your toolkit, how to think like a lender, and the whole economic environment. Now, let's pull it all together into one final, actionable checklist you can use for your next big move.
So before you sign on that dotted line, you need to ask yourself these 4 questions. Number 1, will this debt actually increase my revenue or reduce my costs in the long run? Is it creating value? Number 2, can I cover these payments even in a worst-case scenario? Have I stress-tested this? 3, is this the best type of financing for this specific purpose? Am I using the right tool? And finally, number 4, have I squeezed every drop of value out of my internal cash flow first? This is your final gut check.
And that really brings us to the final thought I want to leave you with today. When you start approaching borrowing with this kind of strategic playbook, a loan stops being just another expense, just another bill you have to pay. Instead, it becomes what it should be, a calculated investment in your company's future. So at the end of the day, the real question isn't if you should borrow, it's how are you going to borrow to build.